Minutes from the November Federal Reserve Committee meeting confirmed that officials are committed to staying the course, but carefully on any future rate decisions. So while consumers appear to be pulling back from buying and inflation cooled slightly, what can investors expect to see from the Federal Reserve as it continues to look out for signs from the consumer and from businesses about the condition of the economy? Let's bring in RBC Capital Markets Head of Rate Strategy in the U.S., Blake Gwinn. Blake, thank you for joining us today. I was just making some comments on the inflation statistics from the report we just got. I don't know if you've had the opportunity to read it, but in general, what is the bond market reflecting in terms of inflation expectations of the general public?
Yeah, at least from the market side, forward inflation expectations are pretty well pinned. We haven't seen any kind of troubling, uptick. The other thing I would point out, I did actually get a chance to just real briefly look at the numbers you were citing on the University of Michigan survey. But, we're getting some kind of mixed signals because I think if you look at the New York survey, for example, of consumers, they don't have that same kind of uptick. Now, there may be a little gap in between when they do the survey period, but it does seem to be something that we're seeing on that University of Michigan side a bit more than either the market measures or what's priced into inflation markets or on the New York Fed's consumer survey.
Yeah, Blake, when you take a look at this consumer sentiment report here from the University of Michigan, obviously pointing to signs that consumers are still a bit worried about what the inflation picture is going to look like here as we look ahead to 2024. But when you take into account the cooling pressure that we have seen on prices from the last CPI print, we certainly started to see maybe a shift in sentiment from investors following that report. Also, what we saw play out in the labor market most recently. How is this affecting positioning into year end and then looking ahead to 2024?
Yeah, I think, for most of the second half of this year, we saw this very large sell-off from July to October. I think, that really had two pieces. I think there were a lot of concerns around Treasury supply and demand. You may have heard of this term premium conversation, but the other piece of that was that we had very, very hot data for a good chunk of the second half. I think that really culminated in September. We had a very hot, if you remember, very hot NFP, then a CPI print, retail sales, and it kind of capped off with that GDP, very strong GDP report we got at the end of that run. Since then, I think we've gotten some signs that things are cooling. The NFP report obviously came in a bit softer. We had a few weak ISM prints. But I think the CPI print, seeing that go down the way it did and, not only kind of miss where expectations saw it, but it's also, just much softer outright. I think that's a pretty important pivot point. And I think, whereas that July to October period, markets really had this kind of bearish lens that they were looking at the markets. They were always looking for a reason to get shorter. And I think people were very slow to take off those short positions. And at the same time, people who wanted to buy treasuries and get long the rates markets were very, very hesitant. I think this kind of flips that narrative a little bit. And I think into year end and into 2024, the markets are going to be looking at things through a much more kind of bullish rates lens. They're going to be looking for dovish Fed speak. They're going to be more attracted to weak data prints than they are to strong data prints. The one thing I've said about the CPI report is when you got that softer CPI report, it does change the context of the way we view the data over the next month. Because I think if that had come in on expectations or, even a beat, if we had seen a bounce in the December data, it'd be much easier to look at that and think from the Fed's perspective and say that's a very worrying trend that we're seeing some signs of acceleration. But now, given that we've had this low CPI reprint, if we bounce back in December, it mostly just looks like noise, and I think they can write it off relatively easily.
And Blake, when we consider what investors are looking at and pricing in next year, we've actually seen more rate cuts get priced in, 4 to be exact, over the last month, and that's up from about 3. And I'm looking at this and thinking that's not always such a bullish thing. Rate cuts generally mean an easier Fed, but it can also be a sign of distress. And we know that when the Fed finally sees a hard landing, it goes from soft to hard landing. It's in an instant. And you see the Fed cutting 100 basis points, 200 basis points at a time. What do you see in the expectations for rate cuts? Anything that might give you caution, or is this just overblown?
No, you mentioned the pricing back in of rate cuts since that CPI print. And as you mentioned, we've priced in about another rate cut into 2024. I very much agree with that price action. We have long been of the view that the Fed starts cutting in the middle of next year. Where I think we're a bit of an anomaly is that we are not in the hard landing camp. I think most of the times people associate the Fed cutting cycle, as you said, with some type of harder landing, the Fed really kind of reacting, being forced to react to the economy, starting to move into that recessionary territory. We see it a little bit differently. I think I think the Fed in this in this cycle is going to have room to be a little bit more proactive. I think the balance of risks around the economy are going to start to shift. Inflation continues to come down as the labor side of their mandate starts to get a little bit more worrisome to them. I think they'll have a lot more latitude to kind of proactively start to shave back the amount of tightness that the rate environment is currently providing for the economy. So this isn't a very reactive, sharp cut back to accommodation. It's really just kind of removing a little bit of the restriction piece at a time, that they've delivered to the economy over the last year in this hiking cycle. So it's really just more of a correction that we're seeing rather than kind of a hard landing. And the other thing I would say is that paring back of restrictiveness may help kind of elongate that soft landing and really deliver that soft landing and keep the economy from tipping into recessionary territory for a little while.
Blake, how much deterioration or weakness do we need to see in order for the Fed to feel comfortable, like you're saying, and make that first rate cut?
I think the bar is actually a lot lower than some people might expect. The reason I say that is because if you think back over the last year and a half, the Fed has really only had one mandate. There are dual mandates, central bank. They have to worry about labor markets and inflation. But really over the last year and a half, we've been near historic lows in the unemployment rate. All they've had to be concerned about is, are we going to see a inflationary spiral kind of kick off? You hear Arthur Burns and Volcker invoked a lot, the 70s type of inflation. So that has been their entire concern over the last year and a half. But with inflation very convincingly, I think, on a downward trend, pulling closer to target, even if it's not quite at target, you get to start looking at things through a much more balanced lens. And I think that's why in 2024, I think the bar is much lower, because if inflation is at least moving in the right direction, it gives them that latitude to be much more reactive to even small bumps. On the labor side, they could be more reactive to geopolitical events. If we were to see banking stress like we had last March kick back up again, they have a little bit more freedom to react to that by, not cutting to zero, but saying, hey, maybe 50, 75 basis points of cuts will help get us through this, or make sure that this doesn't tip in, to a harder landing.
All right, Blake Gwinn, always great to get your insight. Thanks so much for having on with us this morning. RBC Capital Markets head of U.S. rate strategy. Thanks, Blake.